Because our next guest speaker, ladies and gentlemen, is an extremely busy individual. I mean, let's face it, this gentleman has to deal with Rob Moore and Mark Homer, amongst others. So he's taken busy time out of his schedule to be with us here today. He's going to talk about all things tax. So lots of questions that you guys have been asking about tax and how this works with commercial conversions. Chris will be able to answer those, okay? Now, he has opted to be here with us this afternoon. In the past, he's acted for two of the biggest training companies, property training companies in the UK. So give me an ooh for that. Ooh. Yes. He's also been the CFO of a company quoted on the Vancouver Stock Exchange. Give me an ooh. And if you want to buy land in Bucharest, he has worked for the biggest landowner there as well, and some of the biggest communication companies in St. Petersburg in Russia. Yes. So ladies and gentlemen, please, can we have a massive round of applause for Chris? Here he is, Chris Wilkins, everyone.
If you don't want to pay some more.
Thank you. I'm not your usual tax guy, so apologies for that. It's just that he's away. I was seeing Mark today, so I thought I might be able to help with some of the answers. So it's interestingly, when I came in, the song playing as the Taxman, that was George Harrison. George Harrison did that, I think, in the 80s. And what he said is 1 for me, 19 for them. I 5% they got 95%. In fact, in those days, it was worse. The basic rate of income tax went up to 83%, and you had investment income surcharge at 15%. So at that stage, there was 98% tax, and that's when they had the brain drain, and people actually left the country. George Harrison didn't leave, but that's what created the song. And like I say, it's actually worse than that. People like Sean Connery and everyone left. So we're here on the Commercial Conversion Elite course. So I hope you've got lots of questions, but I'd like to start with one question for you. When we say commercial property, has anyone got any ideas how they're going to hold that property? What type of options there are to hold the property? Because the ownership of the property is going to lead us to the taxability of the property. And what we say on our website, it's not what you make, it's what you keep. So the point is, there's no point making loads of money if you've got it in the wrong structure. You need it in the right structure. So anyone got any ideas as to how you can hold a property, a commercial property? Any ideas?
SPV, we had before.
A limited company, that's one. Anyone else? A SAS, pension scheme, 2.
Limited liability partnership.
Limited liability partnership. So that's 3 good ones. Now there's variations of all those. So a limited liability partnership could be also in your own name. Limited company, let's just start off with the simple one. I own it in a company. And the third one, I open it in a pension fund. So it's commercial property, which can be owned in a pension fund. Residential property can't. So let's just work through those and see which ones we want to do. If you want to follow this in a bit more detail, I had actually on our website, which I watch quite regularly, my wife says I'm the only one that actually reads it, but there are some good videos on there. And Mark came to our offices, Mark Homer, he came to our offices, sat round the table, and you could actually watch this, how we spoke about how to own property. And I ran through why I own my property in my name. So you could say, well, okay. So to start with, if I own my business premises in my name, does that mean I'm going to pay 28% when I sell the property? 28%, the answer is no, because 28% capital gains tax is only paid on residential property. So when I sell my property, what rate of tax am I going to pay? 20%. 20% is the rate for corporation tax. I'm a high rate taxpayer, so I'm going to pay it 20%. Residential property, you get a restriction under Section 24 to mortgage interest to reduce it. I've just told you I'm a high rate taxpayer. Do I get my interest reduced on the money I borrowed to buy the property? The answer is no, because it's not residential. So I can get all my interest tax deducted at my highest rate of tax. So if I'm a 45% taxpayer, I borrow money to buy my property, my commercial property, my offices. So I know there's 2 things. 1, I'm going to get 100% tax relief on all the mortgage interest I incur. 2, when I exit, my capital gain currently is going to be a rate of 20%. So that's the structure for an LLP, because an LLP will be taxed the same. It's just more than one person, limited liability partnership, or an individual, just the same. The next one is limited company. So let's say same scenario. I buy the property in a limited company. The limited company has a mortgage. What rate of tax relief do I get on my interest in the company? Current rate of corporation tax is 25%. Profits over £50,000. So I'll be, let's assume they are. So I'm going to get tax relief on that interest at 25%. Companies don't pay capital gains tax, they pay chargeable gains. So company property. When I sell that property, what rate of tax am I going to pay on that chargeable gain? 25%. But that's not my money, because the money then sits in the limited company. How do I get it out of the company? I get out of the company by two ways, salary or dividend. When I get out by dividend, let's just say I've made £150,000 chargeable gain in the company. The company's paid 25% corporation tax on that gain. Then I need to get the money out. I've got to get out of the company. So if I pay myself a dividend, I've already said it's £150,000. So that means I'm going to be paying higher rate dividend tax. Minimum 33%, probably 39 point whatever percent. Effective tax rate, because it's my company. So effective tax rate, 25% corporation tax, 39% dividend tax, to get it out, to get it in my hands. Third scenario, pension fund. Pension fund, well, that must be the ideal way. Why must it be the ideal way? Well, pension funds don't pay capital gains tax. That's fantastic, isn't it? Well, let's think about it. So that £150,000 gain in a pension fund, because it's a commercial property, no tax payable on that. Well, that's brilliant. However, how do I get my money to get it out? When I get it out, I need to draw down my pension. The drawdown of the pension is taxed at my highest rate of income tax. I've just told you I'm a high rate taxpayer. I'm going to pay 45% on drawdown. I don't pay a capital gain because the pension fund doesn't pay the gain. But to get it out, I'm going to have a drawdown each year, which means it's subject to income tax, which is why I explained to Mark that I bought the property in my name, because I'm going to get 100% tax relief on the mortgage interest on the purchase of commercial property, and I'm going to pay 20% capital gains tax on exit. Now, I've had clients that said to me, fantastic idea, Chris, but my pension fund's got all the cash, so I've got to do it a different way. Okay. Or I've got loads of money in the company. So if I have it in the company, then that means I'm going to have a bigger gain in the company. So then you might want to think, well, when do I bite the bullet? Because I've got cash in my limited company. So if I took that cash out, I would suffer an income tax liability on dividend today to buy my commercial property in my own name today. If I didn't do that, I'm crossing fingers and hoping that my commercial property will make a gain. I just said £150,000. That means that will be in the company, and therefore when I sell it, the company will make the gain. So the question is, do I want to suffer some short-term income tax liability now to get the cash out of the company in my back pocket, I buy it personally, or do I leave it in the company, roll it up in the knowledge that if I make £150,000 in 5 years' time, the gain is in the company pays chargeable gains tax at 25%, and I'll pay income tax or salary on getting it out. So you've sort of got to think where we are down the line as to how you're going to do it. So what I'd like to do is I'm happy to take the questions, but on the basis that what we want to do is we want to structure it so that we make it most tax efficient on exit. So a lot of the stuff we do, inheritance tax, business asset disposal relief, which is the precursor was entrepreneurs relief. So entrepreneurs relief, if you have shares in a trading company, you used to get £10 million out at 10% as long as you qualified with the three rules. Must be a trading company. You must have at least 5% of the ordinary shares in the trading company. You must be a director or an employee, and those circumstances must have existed for 1 year. The new rule, BADR, the relief is only £1 million at 10%. Those three rules must have applied for 2 years before doing it. So if you said to me, I want to set up a trading company today, I had a client that came to see me, and he said, I'm just about to sell my trading company, I'm going to claim BADR. I said, okay, how much are you selling it for? And he said, £2 million. And I said, well, £2 million, does that mean you've got shares and your wife's got shares? Because if you both have shares, you get £1 million each, as long as you qualify with the rule. In fact, I don't know if you know, but I've got 18 kids. Me, my wife and 18 kids got 5% each. So we're all going to take £1 million each. It could be something like that. As long as you qualify, the qualification is must be director or employee, must have at least 5% of the shares in a trading company, and that lot must be in place for at least 2 years prior to selling the business. So if you did do that, then what you need to do is set it up. And this client, what he'd done is he said, no, accountant's done it right. I've got 50% of the shares, she's got 50% of the shares. The business is a trading company. We've been going for over 2 years. Everything's fantastic. I thought you said you were a director. Yeah, I'm a director, so I'm all done. What about your wife? She's not a director. Doesn't qualify. So what rate of tax does she pay? He pays 10% on his £1 million. She'll pay 20% on £1 million because she doesn't qualify for bad R. So you've got to set these things up. We did a share buyback for a client, and those rules are 5 years. So the whole point is the tax advice has got to be in advance, not in arrears. You've got to get all this lot in place. Like I say, inheritance tax is 7 years. So you just want to make sure that you get your strictures in place. Now, if, for the sake of argument, I have shares in a trading company today and I sell it today, then when I die, I won't get my business property relief because I've no longer got shares in that trading company. It's only relevant upon the date of death. So if in a normal will, say my will anyway, you've got the spousal exemption, so you leave money to your spouse, that's exempt from inheritance tax. So I had a client came to me, he said, Chris, I said, you got a will? He said, yes. I said, let's look at inheritance tax. I don't want to talk about inheritance tax. What are you talking about? I'm not going to pay it. I don't need to pay inheritance tax. Okay, well, how are you going to avoid inheritance tax? Simple, I'll leave it all to the wife. Yeah, but what happens when she dies? So you've got your IHT exemption, 325. You've got, if you leave a property to your heirs, you've got up to £175,000. That could be £500,000. But then you've got other reliefs. £175,000 depends on the size of the estate. If it's over like above 2 million, it gets reduced. Then what you've got to think about is what other reliefs have I got? Business property relief. So if you've got a business at the moment, and if I drop dead today, that would be exempt. So then I want to leave it outside my estate. So I could leave that to the kids if I wanted, if that was appropriate. Because there's no point giving it to the wife, because I'm then dead, so she couldn't get BPR relief once I'm dead, because there's no business anymore. So you want to do that. And if you're thinking about IHT planning, how about life assurance? If you've got any life assurance, if you've got a pension, you might want to write that into trust, which means it doesn't come back into your estate. It goes directly to the kids if you wanted. So my pension could be written directly to the kids, so it doesn't come back to me when I die. So there's a few, what you need to do is with your tax planning, is you need to sort of work out where you are. I got a client, came to me, very tragic circumstances. She's been told that she's only got 2 years to live. So that makes it a lot trickier. Number one, you've always got to have a will. In this case, the circumstances are multi-jurisdictional, so it depends where the domicile is. But I realise I'm jumping around a bit, but if I can set some of the borderline things, baseline, sorry, you can have a think about it, and that may trigger more questions. But if there's anything that you have burning issues, why don't we get going? All right, sorry, just start off over here.
We're talking about commercial or residential property here as such, basically. My particular situation, I don't want to sell it.
Was it commercial or residential? You got both?
I've got both, basically, as such. Would you recommend keeping it into one company?
How is it held?
At the moment, through a limited company.
Both of them?
Correct.
Why did you do that?
Because that's what my tax accountant told me to do.
Okay. Well, it's a bit like I've just come from Bristol and I got lost and I stopped and I asked the guy how to get here and he said, well, I wouldn't start from here. But we are where you are.
Well, I am correct.
So we just got to sort of try and sort out where you are. Is your inclination do you want to realise those assets?
I don't want to sell them in my lifetime. That is the intention. The intention is to pass them on.
Okay. So one of my clients said to me, I'm not going to pay capital gains tax because I'm never going to sell them. And I said, well, there's two rates of tax, basically. There's two capital taxes you need to be worried about. One's capital gains tax you pay while you're alive, inheritance tax you pay when you're dead. Given the choice, I'd rather pay capital gains tax, even at 28%. So I buy a property for 300 grand. I sell it for 700 grand. I've made £400,000 capital gain. That will be taxed at 28%. If I leave that to my kids, I'm going to pay 40% on the 700,000. So I know which one I'd pay. The problem you've got is a bit like the scenario I said. You've got a property there owned by a limited company. So we know you're going to pay 25% because your profit is going to be over £50,000. And I think what you need to do is the commercial property opted to tax for VAT? Is the building VATable? Do you charge VAT on the rent?
Don't know yet because we're still in the process of planning what it will be. It'll probably be 7 flats.
Right. So you're going to convert that building.
Correct.
Okay. So then if you're going to convert the building, I would be thinking about capital allowances. I would be thinking about ATED.
What's ATED?
Anyone know what ATED is? Exactly. So let me tell you about my apocryphal conversation with Mick Jagger. I don't know if you know, but I know Mick very well in my head. So I live in Barnes, southwest London. He had a property with Jerry Hall, and he sold that property for £20 million. So my conversation goes, Mick, I'd love to buy your property, really nice, got 20 million, I'll just find it in my back pocket. And he'll come back to me and say, Chris, to you, 23 million. So what are you talking about, Mick? We said 20 million. He said, yes, but my house is owned by my BVI company. This is true. It's owned by a BVI company. So you will pay stamp duty at 0.5% on the shares of a BVI company. However, I know, Chris, that you already own a house near Richmond. So on that figure, you're going to be paying 15% SDLT. 15% of 20 million, 3 million, I've saved you just under 3 million, so I'll have the money, please. And that's sort of how it works. So HMRC then said, well, this is costing us a fortune because all the Mick Jaggers of this world are owning their company in their property in a limited company, and we're losing SDLT because he's selling me the shares. He sells me the shares in his BVI company. Stamp duty on that is 0.5%. I'm not getting my full 15% stamp duty land tax. So I'm going to have to do something about this. What are we going to do? We're going to bring in ATED, Annual Tax on Envelope Dwelling, ATED. An envelope dwelling is a dwelling owned by a non-natural person being trust, limited company, etc., etc. It doesn't matter the jurisdiction of the company. In this case, it was a BVI company. So what happens then is they'll say, well, this is going to cost us a bloody fortune. So we're going to bring in ATED. How much will ATED bring in? I don't know, but let's say that any property over £2 million and we'll get some tax on it. In the first year, they made all the tax they budgeted to make in the first 3 months once they realised who was in it. And they said, oh, this is great. Let's reduce the value of the property down to £1 million. And the same thing happened. So now they've reduced it down to £500,000. So if I own a property in my limited company, residential property, if I live in it or not, I have to register under ATED. If I don't, then there's a fine. If you then rent it out to third parties, tenants, it's fine, but you've got to register under ATED. And the problem is, I'm trying to think of this American politician who said there's the known knowns and the unknown knowns. And the point is, a lot of it, things with tax, is you don't know what you don't know. And if you don't know, it can get expensive. And the problem is, if you don't know the right people to ask the question, you're going to get caught out. So that's what ATED is. Just be careful of ATED. Capital allowances. So ATED doesn't kick in until it is a dwelling. Sir, sorry, what's your name? Ian. So what you're going to do, Ian, is you've got a commercial property and you're going to convert that to residential. Correct. Presumably you're going to claim VAT 708. So your VAT is going to be taxed on you by the builder at 5%. Okay, so you're going to save a bit of money on the VAT. Then what you're going to do is you can convert them to residential dwellings. The residential dwelling, ATED, doesn't kick in until it is a dwelling, generally when the council give it a rateable value, generally. So then that means that ATED will start, you'll have to register, you're not using it personally, you're giving it to tenants, so therefore you won't have to pay it, but you did have to register. You would then claim capital allowances on the conversion costs. So say I buy this building today, and this is a commercial building, and I pay £1 million for it. The £1 million includes things like radiators, air conditioning, perhaps a lift, whatever. Those are capital assets I can claim capital allowances on. You get a capital allowances consultant, and he can make a claim. And that claim can be offset against, in this case, your corporation tax liability. The great thing is that claim, you would think, would reduce the purchase price of the building, but it doesn't. So when we come to do the capital gains comp, the base cost is still £1 million for the purchase price, not £1 million less the capital allowances you've claimed. Sorry, did you get that? Is that a bit quick? No? Okay, so I buy it for £1 million, and I've got a capital allowances consultant that comes in and he says, I've added up your radiators, I've added up the air conditioning, and I've added up your lift, and that comes to £200,000. So we're going to make a claim for £200,000 against my corporation tax liability. So you'd think, well, £1 million purchase price, £200,000 claim on day one, net cost 800. It don't work that way. Net cost is still a million for the purchase price. And when I sell the building for 1.6 million, the chargeable gain is 1.6 less $1 million, not anything other figure. Okay, that's good. Yeah. So you want to make a capital allowances claim on that. Then you will claim for the enhanced costs of the building works, and somewhere along the line you're going to get capital relief, or you're going to offset the repairs and refurbishments against your allowances. So am I right in saying that, Ian, your commercial property will be residential, so your portfolio will all be residential?
Correct.
Okay. So then you won't have opted to tax on any buildings, because you can't opt to tax a VAT on residential property, only commercial. And then you'll have your income in the company, and then the question is how you get the income out of the company. If you own those shares forevermore and die with those shares, then what you'll do is those shares will be shares in a non-trading company. So you ain't going to get business property relief because it's residential rental income. Residential rental income does not qualify for BPR. BPR is an exemption for all inheritance tax. So if I sort of go back, anyone heard of Elizabeth Moyne Ramsey? Elizabeth Moyne Ramsey, Section 24. She had 10 flats in, I think it was Dublin, and she then put those 10 flats in a limited company. So if I own one residential property, sell it to you, or give it to my son, the capital gain is the same, because a gift is deemed to a connected party is deemed to be at market value. If I sell it to you, my capital gain is the same figure. Then if you then give it to your limited company and it's one property, do you pay capital gains tax? Yes, you do. Why? Because it's not a business. You wanted to claim Section 162 incorporation relief is basically what you want to do. And so you want to stuff that in your company. The question is, what is a business? A business isn't defined in the Taxes Act. And it went to the first tier tribunal and they said, well, you ain't going to get business property relief because it's residential. So, sorry, but you lost. So you're going to have to pay capital gains tax. So then her son took it to the upper tribunal, similar level as the High Court. And the judge there was Judge Berner. And he said, I don't understand what this judge said in the first tier tribunal, because he said business property relief. But business property relief is an inheritance tax exemption, not a capital gains exemption. And we're looking at capital gains because no one's died. So therefore the question is, could we claim incorporation relief? Could we actually say you're running a business? Now, there is no definition of a business, but I've got some clients that have got like 60 or 70 properties in their own name at that stage, going back a few years. They've got staff, they've got agents running it, and that definitely is a business. I've got clients with one property, which ain't a business. So where along that line does it become a business? So he said, well, let me know what does your mum do? He said, well, she's always mending fences, she's vetting all the tenants, she's checking all their credentials, she goes around cleaning the place. Okay, anything else? How long does she spend on this? She spends about 20 hours. Okay. And out of interest, out of those 10 properties, how many are let at the moment? About 5. So that sort of set the rule for Elizabeth Moyne Ramsey. And the case is, it's a business if you do 20 hours and you've got 5 properties. Now, you could say, well, I've got a massive HMO, which is one building, has got 20 tenants, and that would qualify as well, because I actually spend more than 20 hours. And Elizabeth Moyne Ramsey was the precursor to the Section 162 incorporation relief. And that's sort of how it happened. But the problem you've got in Ian's case is he ain't going to get an IHT exemption when he sells those. So the problem with that is that he either pays capital gains tax by selling the asset before he dies, he gives it away to a connected party, which will give you the same capital gains tax liability, or he owns those shares upon death. Are you married, sir?
Not yet.
Okay, you might consider it. So what you could do,
I knew that was coming.
well, our advice to one of the clients is you actually gift it to your wife upon death, you get an IHT uplift upon death. So let's say I own a property, residential property, and I die and leave it to my wife. She gets the spousal exemption, which means no IHT, but she receives the asset at the market value at my death, which increases the base cost. Now, it's a bit extreme, you have to die to claim the rule, but that's how the rule works. So not that I recommend taking advantage of that rule, but it's there. It's there.
Interesting. Through this entire course, we've always been talking about converting buildings completely into residential. Interesting point you brought up there was, is it all being converted into residential, yes or no? If you get into bigger projects as such, basically, Mark and Rob did one where effectively as such, this thing simplistically, they had a trading business on the ground floor that's renting out and then residential's above that as such, basically. Are you suggesting by that then as such, if we've got a property which isn't going completely residential, you want to put that in a separate opportunity because that's then a trading company effectively as such?
Sorry, I'm laughing because you're telling me the tax planning that I did for them. So yeah, I know that one, yeah. So, sorry, the next bit was?
If you get into projects where you've got a mix of renters, residential and commercial, so in other words, you're renting out the ground floor, for instance, to a corner shop, a laundrette, and a tobacconist, for instance, and then the upper floors are residential, you want that in a separate company by the sound of it from your residential only holdings, or a separate SPV?
Why?
Because effectively, is it a trading company if you've got a mix of tenants?
Well, it depends whether you're active or passive. If it's passive rental income, if I get rental income from my tenant and I give them a 25-year lease and I don't do anything, I don't think that's going to be a trade.
Oh, right.
You've got to be a trade to get business property relief upon death. So it's got to be a trading business.
Right.
And if it's not a trading business, if my rental income is passive, i.e. I don't do anything, then I won't get over the mark. So let me give you an example. How do I make my business, my residential business, a commercial business, a trade? I could be a hotel. I could be a guest house. Why does that make it a trade? Well, I'm getting up every morning doing breakfasts. I'm changing the rooms. I'm physically doing something. So I'm transgressing from a passive rental income where I just get rent every month to physically running a trade. So if I'm running, like I say, a hotel, a guest house, that would be classed as a trade because I'm actively working in the business and I'm trading that business. So it's a case of where you fall, a bit like Moyne Ramsey is where you fall, where does it become a business? This we're talking about is a trade, different word, but there's no definition of business, there is a definition of trade.
Thank you.
Sorry, sir, you had a question?
I did. It seems a bit simplistic now, to be honest. This is completely residential. My mother has got a house which is 2 doors down from mine, which she's never moved into, which we rent currently. Because I basically paid half of the build cost, she effectively gives me half the rent.
But she owns the property.
She owns the property. It's not really declared, if I'm honest. And when the inevitable happens, she's obviously going to give me her 50, or she's going to give me 100%, it's effectively in her name. Is there any way that I can not have to pay a massive amount of tax if we sort of do something now rather than?
What would her total estate be upon death?
She's going to be just over £1 million.
£1 million. So she will pay inheritance tax.
Yeah.
And she's never lived in the property.
She's never lived in it.
So if she gave you half of the property today,
Yes.
she would pay capital gains tax.
Yes.
Who declares the rental income? You declare 100% of it?
Yeah.
On what basis if you don't own the property?
Exactly, that's a very good question. The reason is that I actually originally lived in it and rented out property that I own. Now we had some work being done on the property that I rented. So rather than upset the tenant, we swapped houses. Because I had a lot of field work going on, which would have effectively been in my tenant's back garden. So I thought, right, probably the nicest thing to do, being the lovely landlord that I am, that she goes and lives in the house that I've lived in, like effectively my mother's house, whilst this building work carries on. So I'm left in this situation where I'm now renting out a house, which is where I'm collecting the rent, but it's actually my mum that owns it.
So this is another one. There's another one where I say, well, I wouldn't start from here. So what you could have done is when you moved into the property, if your mum had given you a chunk of the property then, you could have claimed it as your PPR, your principal private residence, because if that was your sole property and you lived in the property, A, you can only claim principal private residence relief if you own the property, which you didn't. So you couldn't have claimed it. If she gave it to you, then you would have moved into it. The gain that would have accumulated during your residency would have been free from capital gains tax. Depending on how long you go back, if you go back to the MPs when they were flipping, the last 36 months of ownership were free for capital gains tax, so you live there, then if you rented it...
This is only sort of 10, 12 months ago.
Okay. So how long has the property been owned?
Well, it was built from scratch.
Okay.
And it was built in 2016.
So you could, okay, if we talk about the current legislation, you could move into it, claim PPR relief on the basis that she gifted it to you. The period that you lived in it would be exempt. Then you move out somewhere else. Then you rent it out. So the last 9 months of ownership would be free from capital gains tax. Could you have claimed principal private residence relief?
I can still do that now.
Well, you can't because you never own the property. And you can't claim it. But I'm just sort of giving you, I'm extrapolating your reply. The problem you've got is you aren't liable for capital gains tax. The other problem you've got is, has anyone heard of Connect? Connect is HMRC software. They reckon it's got 55 billion pieces of data on it. And so they've got a landlord dispensation at the moment. So what's quite common is you get people who rent out property and never tell them, say that, never declare the rent. And on this Connect, it will say 7 Lettsby Avenue. Well, that's funny because we've got a Virgin bill in the name of Frank Smith. We've got a gas bill in the name of Frank Smith. We've got a TV license in the name of Frank Smith. But Joe Bloggs say that he lives there. Connect, with these 55 billion pieces of data, has this ability to prove you wrong. And there's now a Landlord Reform Act that came in last month that is now going to have a register for all the landlords or prospective landlords. No, but what I don't understand is you can't, I'm struggling to see how you can declare the rental income on a property you don't own. Now, the best you would probably do is say that your mum either gave you the managing rights, but that I would suspect that wouldn't be 100%, but that means she'd still have some income and you'd have some income. And I think you need to rationalise that, sort it out as soon as possible, and out of interest, does it sort of doesn't, HMRC don't really care if you are saving tax or not. It's wrong. So she should have done a tax return. And it may be that when she does her tax return, her tax bill was less than yours. But the trouble you got is you've got to go back and correct it.
Somebody told me that possibly a good thing to do would do like a rent-to-rent on it. So I pay my mother X amount of money.
But then she'd still have rental income, which hasn't been declared. So then you both have a declaration, and you're probably telling me that now you've overpaid your tax because of that, because you paid a tax on 100% of the rental income.
Yeah.
So, yeah.
Yes. So what happens going forward? I mean, obviously I need to sort that out. I appreciate that. I'm trying to. But what now happens in terms of her will? Is there any way that I can avoid paying that massive on something?
Well, she could gift you part or all of the property.
Is that an election to give? Is that what they call it?
No, it's not an election. You thinking of Form 17, beneficial
Somebody told
trust?
me to do an election gift, so that at the time of the inevitable, it's the same of some description.
Well, if she gave you the beneficial interest in, let's say, 50% of the property today, that would trigger a capital gains tax today. So I don't think you could say that you owned half of it, pull this piece of paper out in your back pocket in 10 years' time when she dies. Because then they'll say, well, if you own half of it, A, why wasn't it registered at the land registry? And B, why didn't she declare the gain 10 years ago? Because if she said she gave you that, and she can't claim any other reliefs, such as PPR relief, principal private residence relief, then she should have paid capital gains tax, and then you'll get interest and penalties on it for that period. I mean, it might be better to bite the bullet and suffer 28% rather than 40% inheritance tax if her estate is £1 million, and if that's going to push it over the 325 exemption. I mean, she might get the other 175 relief, residence nil rate banned. But
Can I talk to you about it? Can I give you a shout?
yeah.
You'll enjoy this one.
Yeah, I mean, that's sort of a lot of it is that it's a case of you just got to work out the possibilities and the scenarios and try and plan what is the most tax efficient to dig yourself out of a hole. But I would strongly suggest that pulling the covers over your head and hoping it'll go away won't work, especially with Connect.
I'll try not to.
Especially with Connect around. The HMRC have got so much more information on everything now, and it will come out of the woodwork. And if they say a scenario would have happened, you could be looking at something like 100% penalties. You work out a tax bill, and it could be 100% of the penalties on that because they've come to you rather than you coming to them. And the idea is that if they can then prove fraud or willful default, and then you're complicit in that knowledge, you've got a problem. So you've got to sort of like just be upfront of it and negotiate it. And you might be able to get through, there may be some exemptions that you can claim, but it's just a case of, in the whole scheme of things, it might be better to pay capital gains tax than inheritance tax upon death anyway.
Chris, in that instance, am I right in thinking that there is a risk if you're sort of getting later on in life and you're trying to maybe make that decision to take capital gain rather than inheritance? If you pay the capital gains and then subsequently die within 7 years, does that asset value then get brought back into the estate, assessed for inheritance tax? You paid your capital gains, which you won't get back, and then you get stung to 40% on inheritance tax. Is that a real risk?
You know what they say about death and taxes? Yeah, that is a risk.
28 and then the 40.
So and we've, one of our clients has come up with that scenario, and what our suggestion is if there is strong likelihood that they may die in that period, they take out life assurance. And you can assure your life for such as the liability. So if you think I could be liable for 40% tax, then you can insure your life for that much. You want to write that out of your estate so that it doesn't come back and be taxed again as part of your estate. But then you are protecting, you've got each way back. Yeah, the cheapest one is something like a term policy. 7 years, term policy. So it's if I die within 7 years, you pay out X. If I die in 8 years' time, you pay out 0. Well, that's fine, because in 8 years' time, I wouldn't have paid the IHT anyway, and the only insurance is for the IHT. It's to cover the IHT, but if you have a term policy, it's cheaper than having something no limit on time.
So if there's a transfer, you want to cover the cost of that.
That is the issue, yeah, and that is concern. Unless, is this person married? Yes. So then there's a case of whether there's a spousal exemption, which would put off the 7 years. So if that person left the assets to their spouse, and if that spouse lived more than 7 years, then whether that would avoid the IHT crystallisation. Because there's no IHT between spouses. And you might get an uplift in the value of the property, which might avoid the CGT. Hallie.
Can you actually transfer the equity on your residential to your children?
Do you live in the property?
Yes.
Do they live in the property?
Yes.
They do?
Yes.
How old are they? Minors? Over 18?
22.
22, okay. So what you've got to think about is a gift with reservation. So a gift with reservation is I've got a Renoir in my lounge and I don't want to pay inheritance tax when I die. So I've just done a letter to my son and said I've just given him the Renoir, but it's still going to stay in my lounge. And HMRC will say, well, what do you mean? It's a gift with reservation. You've reserved the benefit of that Renoir because it's still in your lounge. You've still got the enjoyment of looking at that Renoir. If you want an exemption for inheritance tax, you've got to give him the painting. So generally what happens with property is if you want to stay in the property and you give it to your children, A, they've got to live in the property, but you're still getting a benefit. So it may be that they live in half the property and you live in half the property, and you give them half the property, and you each pay your bills, half of the bills. And that may work. But it's only if they live in the property. You can't give the property to someone else, but you stay in the property, because then it wouldn't be an IHT exemption.
Well, I'm actually thinking that I will give them the equity for them to go and buy their own.
How do they access the equity?
That's why I'm asking.
I think metaphorically you've shot yourself in the foot, because you just said you're going to give them the equity for them to go and buy somewhere else. So if they bought somewhere else, they wouldn't be living in the property.
No, they won't.
But then you can't give them half of a property they don't live in and you live in, because then you've enjoyed their half. So the only way it'd work is you'd have to give them rent on the half that you don't own. Otherwise, it's null and void for IHT, because you're saying you own half a property, they own the other half, so therefore they should be charging you rent at the market value for you to live in the other half. Otherwise, it ain't going to work for IHT exemptions.
What if I sell the property and take the equity, give them, because maybe I'm going abroad or something? So I'll just take can I just take the equity, give them and sell the property?
Well, you can do that anyway. I mean, if you wanted to remortgage the property and give them the cash, you could do that, but that wouldn't be an IHT exemption. That would be just a gift. You can do that, and you can give them a gift, and that's called a PET. PET, potentially exempt transfer. It's a PET. It's potentially exempt transfer for inheritance tax as long as you live 7 years. There's a sliding scale. If you make a PET today and died within 3 years, it is as if you didn't do it. In years 4 to 7, they've got a sliding scale of your IHT liability. So ideally, you want to live 7 years. Don't ask me to sing a song. This lady said I was a... Who do you say I will look like? Sid Vicious, I don't know. Don't ask me to sing. I'll answer a tax question if you don't mind.
Can you come back to the Landlord Reform Act register?
Yep.
And also, I've got a question about how you hold a buy-to-let portfolio in sole names but ensure it gets passed down to children. So that it's not messy.
Well, number one, you need a will. You can leave a buy-to-let portfolio to your children, but if you did that, you're going to pay inheritance tax upon your death. May I ask, are you married?
Yes.
Would you would consider you leaving it, or would you leave it to your husband and he? I'm just thinking of the uplift on death.
We've got a will, so everything automatically reverts to spouses.
Okay.
So if I died, it would all go to him.
Okay.
When he dies, everything then goes to the children.
Okay. So.
But what if because three of my children are over 18, most of them, because I've got loads, I haven't. 3 are over 18.
Don't worry, I've got 18 kids.
Have you really got 18? No.
18 plus mum and dad, 20, 5% for my BAD-R, business asset disposal relief claim. Sorry, I digress. Look, if God forbid you died today, if your will said that the properties were left to your spouse, then he'd get an uplift on the value of those properties. So if they're all in your name, let's just assume they are. And the problem is if he dies first, then what happens? But let's assume they're all in your name, you die first, then you leave them to him, he gets an uplift on death, then he gifts them to the kids. His base cost for capital gains tax is the market value upon your death. He then gives it the next day, no capital gain. As long as he lives 7 years, it's a pet. I wouldn't recommend it, because the trouble is what if he dies and the properties are in your name, then it ain't going to work.
Incorporate and then issue shares? Because that's what I've been advised before.
Well, I mean, there's degrees in all this lot. If you incorporate and then you died, what's in your will? In your will is the shares of a limited company that owns the property. So those shares will still have a value. And there's still going to be IHT payable on the shares. You haven't avoided it. You might have got it out. Well, you won't. You won't avoid it because I was going to say, it may work for capital gains tax, but I don't see how it works for inheritance tax, because if I've got £1 million of property, I put the property in a limited company, that limited company's got shares, and those shares have one asset, which is the property. It's worth £1 million. So upon the death, you've got £1 million worth of shares. So those shares are going to be subject to inheritance tax of 40%. I mean, you might want to do it for other reasons. You might want to start giving the shares away today, if you wanted to. That would create a capital gains tax, and it may be that the capital gains tax is only going to be at 20% rather than the gift of residential property will be at 28%, depending on when you did it and whether you claim Section 162 incorporation relief. But it might be the way of doing it. So these are sort of capital taxes we're talking about now: capital gains tax, inheritance tax. Yes, sir.
Question actually. Okay, I have a consultancy company. I want to invest that money, or that consultancy company into properties. And I also own a property company as well, limited company. And obviously I want to make sure I want to minimise the amount of tax I pay. But I'm probably going to be.
You're in the right room then.
Yeah, so I'm probably going to be holding it until, forever, and then we pass on to my children in terms of property. What's the best way of loaning, potentially, to the property company?
So if you've got one company lends money to another company, it doesn't crystallise any tax liability. You don't have to charge interest. There's no crystallisation of income tax. And then this company, say this one starts off today with £1 million from that company loan, then this company can use that £1 million to buy property. The property hopefully goes up in value, and then in the fullness of time, this one may take out a mortgage and pay that £1 million off, when hopefully this property is worth a lot more than £1 million. And you could use this as basically your funding vehicle for that.
That's what I'm trying to do, yeah.
So you could do it that way, yeah. I would go back to my previous answer. The question is, if you want to keep that till you die, that as a property trading, a property investment company, it would probably be subject to 40% inheritance tax upon death, because you won't be able to claim any other reliefs. So you may want to consider whether you want to start giving the shares prior to your death, which would incur capital gains tax rather than inheritance tax.
What sort of shares should they actually be? Do they have children? I've heard of these ABC shares or something. How should that be structured when you have children?
So what you want to do is ideally you set up if you set up this company today, have you heard of family trading company? Family trading company.
No.
So a family trading company may be, I'm going to set up 20 shares in my company. Me, the wife and 18 kids. A, B, C, D, E, F, G. All the rest of it. I'm setting this up today. What's the value of these shares today? Well, it's a £100 company, so each share is worth £1. I'll lend £1 million to this company, and depending on the ownership of those shares, those means that the capital gains will be in their individual names. If you do it today with one share in your name, and then you transfer the shares to them in 20 years' time, hopefully the company's got a greater value, but that would mean that you would then have a capital gain in 20 years' time because you've converted something that is more than £1 a share, because the company would have a better value. So ideally, if that was your inclination, then you may want to set up a different share structure today.
Is that the best way of doing it? Because at the moment, a couple of my kids are minors at the moment, and below 18. I don't have 18 kids though, but we've got 3. And so therefore, in that case, obviously, do they need to be directors of the company, or
For what?
just be shareholders?
Need to be directors for what?
Or of the company, the property investment company?
Well,
Can they just be shareholders?
unless you think you're going to claim any other reliefs, but you won't get bad R because it's not a trading company, so you don't need a director for that reason. So the simplest way is you just make them shareholders. But what you've got to be very careful of is the settlement legislation. So the settlement legislation basically says, I've got a very valuable trading company at the moment, and I've got, out of my 18 kids, 3 of them are at school. So what I'm going to do is I own the shares of my wife, so I'm going to give the kids 1 share each. I'm going to give them a dividend of £50,000 each, because I'm so rich, I'm a millionaire, I'm paying 45% income tax. They have a personal allowance, even though they're only 3 years old, and they can get £12,570 tax-free. Then the next chunk of, they'll just pay just over 8% for dividends, so then get 50 grand out. And then I'll use that to pay the school fees. Now, HMRC have this thing called Spotlight. Spotlight highlights all the things they think people are doing. And there's a couple of big schemes that a couple of accountants are doing at the moment that just don't work. Because what I've just told you is a gift from parent to minor child would fall under the settlement legislation, because I'm making a gift of income. Number one, I can't give them a share for £1 and they get 50 grand dividend each year, because that's not the market value of the share. Number two, a gift from parent to minor child to divert income falls under the settlement legislation. Famous case, Jones v. Garnett, called Arctic Systems. I could go into it, but I'm sorry, time is a bit short, but let me just see there's a couple of quick questions before we run out. I've got to meet Mark. I don't want to keep him waiting. Yeah, the settlement legislation basically says that Jones v. Garnett was a case of a computer consultant earned 200 grand a year, and his accountant said 200 grand a year, but you're losing your personal allowance because you earn over £100,000 and you're in a high rate tax. Why don't you give your wife a share, and then she can have 100 grand and you can have 100 grand? Because at the moment you've got a 1 share company and the 200 grand dividends in your name, but your wife has no income, but she assists in the administration of the company. So if there was 2 shares, you could have dividend of 100 grand each. Both of you would keep your personal allowance, and neither of you would be high rate taxpayers. Jones v. Garnett was the precursor to the settlement legislation. The settlement legislation basically says, is that a bounteous settlement? Yes, it is, because you're giving her a share for £1 that gives her 100 grand income. There is a way out round it, But that's the next one. That's the next venture. So, Dan, is that? Sorry, are we okay? We got one more. Let me do one more. Then I've just got to go.
You mentioned pensions, and you touched on funding commercial investments through pension.
SAS or SIP.
When would that be appropriate? Is that a loan? Who structures that?
Well, if you've got a big pension fund from an employer, let's say it's your firm, it may be that pension fund does all the cash, and you say, I fancy doing commercial conversion, but I haven't got any cash in my own name. How can I do it? Well, you could get, the pension fund may be able to lend you money, but that's probably 50% of the total funds. Or you might be able to buy the property in the pension fund name, which is sort of what I explained when we first came in. So that's a scenario. So, okay. Sorry it's short, but I hope that was useful anyway. So I'm Chris Wilkins, Wilkins Southworth. Hope to see you again next time, and good luck in your property ventures.
Thank you very much, Chris. Thank you. Thanks very much for coming in.
Pleasure.
So Chris's company, which is Wilkins Southworth, if you want to look up them online and contact Chris for any of those advice type pieces rather than illustrations, feel free to do so. Just let him know you met him here, so that he knows that you've come through this training as well. Let's hear it one more time for Chris, ladies and gents. Thank you. Thank you, Chris.